34 bullish stocks, 0 bearish. That's not a typo. That's one entire healthcare sub-industry right now, and almost nobody outside Wall Street desks is talking about it. I'm Alex Carter. Welcome back to Wealth Signal. While everyone's obsessing over the next AI chip announcement, an entire sector has been quietly running one of the strongest bullish streaks in the market. And if you're only watching tech, you're going to miss it completely. This breakdown is based on a sector-by-sector and stock-by-stock ratings scan across the entire S&P 500 healthcare space, cross-checked against real earnings data and analyst price target moves through August 2026. If you want more breakdowns like this, the ones that catch a move before it's obvious, hit subscribe right now, because this channel is built entirely around finding these setups early. Today we're covering 3 healthcare stocks riding this exact wave. One already up triple digits over the past year, one still catching up to a nearly $400 price target, and one small enough that most investors have never even looked at it. Stick around, because by the end, I'll tell you which of the 3 actually has the most room left to run. Let's start with the headline everyone's actually asking about. A new executive order just eased the required vaccine schedule for babies, giving parents more control over their kids' vaccine regimens. It made a lot of noise in the news cycle this week. But here's the thing. That executive order is more of a political story than a market driver. It's not what's actually moving healthcare stocks right now. The real story is something almost nobody's covering. Look at the S&P 500 healthcare sector as a whole, the XLV. Out of the 24 large-cap stocks in it, 24 are currently rated bullish on both fundamentals and technicals. Only 1 is bearish. That's about as one-sided as a sector gets. Drill down one level further, into the managed care industry group specifically. The ETF ticker is XHS, and it's even more lopsided. 34 stocks bullish, 0 bearish. A part defensive, part growth group that's been quietly outperforming under the radar. So, why now? 2025 was genuinely brutal for managed care. Federal subsidies got pulled, medical costs kept climbing, and insurers couldn't raise their rates fast enough to keep up. It was a rough year across the board. 2026 flipped the script. These companies instituted real cost controls, hiked their rates, and lost fewer subscribers than analysts had feared. And the subscribers they did lose were mostly the less profitable ones. It's been close to a perfect storm, in a good way. First up is Centene, ticker CNC. If health insurance sounds like the most boring possible pick on this list, stay with me, because boring is exactly what's been working. Among the big healthcare providers, Centene stands out as the most efficient at managing costs and staying ahead of rate increases. It's smaller than giants like Humana or United Health, but it's focused specifically on the Affordable Care Act marketplace, and it's executing better than its bigger peers. 2025 was a genuine nightmare for this company specifically. Subsidies came off, costs kept rising, and Centene simply couldn't keep pace. But in 2026, management took the reins. They've reduced debt and raised rates, and even though subscriber growth is expected to slow slightly, they're retaining their most profitable customers while losing the less profitable ones. Then came the earnings report, and it was fantastic. A clear, positive surprise, with guidance raised twice this year. That's the kind of signal that tells you management sees the turnaround holding. Here's where it gets interesting for you as an investor. The stock actually sold off around 8% after that strong earnings report, which sounds bad, but it's actually a textbook pattern this earnings season. Strong numbers, initial spike, then a sell the news pullback as short-term traders take profits. Imagine you were watching that pullback in real time, seeing a company post a genuine earnings beat and then watching the price dip anyway. That's exactly the kind of moment where the loudest voices online say something's wrong, when the data was actually telling you the opposite. And the chart backs this up. Between April and May of 2026, this stock doubled in a single month. That happened because analysts had been behind the curve. They underestimated the first earnings surprise back in April, and once the real numbers came in, they scrambled to catch up with their estimates. The ratings model first flagged this stock as bullish back in late November into January, when it was trading around $40. Everything since then has been the market slowly catching up to what the data was already showing. The underlying lesson here is simple. Strong fundamentals plus a strong industry group plus strong technicals doesn't mean you missed it. It means the trend has real support behind it from more than one direction. That combination is worth more than chasing a single hot headline. Quick gut check before we move to the next name. If this kind of sector-level breakdown is useful to you, drop a like on this video. It genuinely helps this channel reach more people who are missing moves like this one. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future videos file. Links in the description. Go grab it. That whole managed care story we just walked through, it's not isolated to one stock, and the second name on this list proves it. This one's ticker is COR, a much bigger healthcare giant that's actually just starting to come out of a downtrend. This company is one of the largest healthcare providers in the country, built through years of consolidation of different healthcare businesses. Honestly, the scale of its numbers is hard to even wrap your head around. Its most recent earnings report, which came out about a week before this video, beat estimates by roughly 7%. And the ratings model only just turned bullish on it in mid-July, meaning this is a much earlier stage setup than Centene, which has already made its big move. That's actually the point of picking two very different stocks here. One, like Centene, that's already run hard, and one that's just getting started. It gives you exposure to both the momentum that's already proven and the momentum that's still building. Consensus analyst targets put roughly 20% upside on this stock from current levels, with the stock aiming to reclaim its previous highs around the $370 area. But some of the more recent price targets from August are calling for the stock to move toward, or even past, $400. Here's why that matters more than it sounds. When one lead analyst on a stock breaks away from the pack and raises their price target, other analysts very often follow. That creates a momentum effect on the earnings and price target side that's separate from, and adds to, whatever the stock's chart is already doing. So what's actually driving this across the board? Not just for this one stock, but for the whole group. Rising healthcare prices for one. Costs in this industry have been climbing for decades, and that's not exactly breaking news. What makes healthcare genuinely different from something like AI infrastructure is that there's no single catalyst that flips the entire industry overnight. It's steady, it's bread and butter, and it's not going anywhere, while also quietly being a real growth story, not just a defensive one like utilities or consumer staples. And AI is starting to touch this space too, not by replacing it, but by cutting costs, improving how these companies interact with patients, and helping them anticipate where their next cost increase is coming from before it hits. Here's a trap a lot of investors fall into without realizing it. You might think you're diversified because you own a utility build-out stock or a data center cooling company. But if that business is really just clearing land or cooling equipment for the AI boom, you're still making one bet. Healthcare, on the other hand, is a genuine way to diversify away from that exact risk, often with a dividend attached. Our third stock has one of the more unexpected origin stories on this list. Fresenius Medical Care didn't start as a dialysis company at all. It traces back to a small pharmacy in Frankfurt, Germany, founded all the way back in 1912. Decades later, that same company would go on to become the world's largest dialysis provider, today treating roughly 9% of all dialysis patients on the planet. That matters here because Fresenius treats kidney disease in both the US and Germany. And kidney disease is a serious and growing problem in America, closely tied to diet and to alcohol-related health issues. The setup on this one looks a lot like Cencora. The ratings model turned bullish in June, slightly earlier, and the company just posted a strong earnings report. The stock spiked above $26, then pulled back to around $24, roughly a 10% discount after genuinely good news. This is a mid-cap stock, only about $12 billion in market value, which makes it the balance point on this list. It's not as large or as proven as Centene, and it's not the multi-billion-dollar giant that Cencora is. It's the smaller, still developing piece of the puzzle, and the volatility here tells its own story. This stock's 52-week range is about $20 to $27.50, a narrow band. Compare that to some mid-cap tech names that can swing anywhere from $3 to $300 in the same period. If those tech swings are a hurricane, this is closer to a gust of wind. It'll still be more volatile day to day than a giant like United Health or Centene. That's normal for its size. But having a disciplined process, ratings plus technicals, plus always checking the sector and industry group for a tailwind, is what turns that volatility from a threat into an opportunity instead of a reason to panic. No sector is risk-free, so let's be straight about this one. Historically, there's really only one meaningful risk to the healthcare sector as a whole, and that's government regulation. The vaccine executive order that opened this video is part of that regulatory picture, but it's mostly a political story, not one that touches critical care areas like kidney treatment or managed care in any serious way. For the managed care names specifically, Centene and Cencora, the real risk to watch is reimbursement rates not keeping pace with rising medical costs. That's exactly what went wrong in 2025 and exactly what got fixed in 2026. Competition, notably, isn't really a factor here at all. Before I close this out, which of these three do you think has the most room left to run? Drop your pick in the comments. I read every one of them. And here's my honest ranking, from the one I'd watch closest to the one already proving itself. Number 3. Fresenius Medical Care. It's the smallest, the least proven of the three, and the most volatile relative to its own history, but it's also the one with the most room to surprise to the upside if the 10% post-earnings dip keeps closing. Number 2. Cencora. Bigger, more established, and already earning fresh bullish ratings and rising price targets. But it's earlier in its move than Centene, which is exactly why the upside case, current targets pointing toward $400, is still this compelling. And number 1, the one already proving the whole thesis, is Centene. Doubled in a month, guidance raised twice, and still sitting well below where some analysts think it's headed. It's the clearest example on this list of what happens when fundamentals, industry strength, and technicals all point the same direction at once. If breakdowns like this are useful to you, make sure you're subscribed. This channel is built around catching sector rotations like this one before they're obvious to everyone else. And if you know someone who's only watching tech stocks right now, send them this video. Healthcare just quietly became one of the strongest stories in the market. And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. I'm Alex Carter, and I'll see you in the next one.